The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good Friday afternoon. Welcome to you from all of us here at Ausbiz. This is The Call. 10 companies picked by you, 2 expert guests, 1 hour for Friday, the 8th of July. A warm welcome to my 2 expert guests on today's show. Here with me for the full hour, we have Luke Winchester from Merewether Capital and Claude Walker from A Rich Life. It's so nice to see you both on this Friday. I hope it's sunny where you are. It certainly is where we are here in Sydney, and we've got a bit of a spring in our step on this Friday afternoon. That being said, guys, look, there's not a lot of corporate news around right now, is there? We're sort of in that lull as we move our way through confession season towards earnings season. So I thought instead of the stock of the day, we'd just get straight to the Friday and do a Friday buy. Luke Walker from A Rich Life, can I start with you? What would you be buying on a sunny, positive, in terms of the index day like today?
I'm guessing that's for me. So, it is a lovely day. Thanks for having us, Nadine. The truth is on today, the last couple of days have been quite strong up days, and a lot of the kind of growth stocks that I tend to be biased towards have had a great couple of days, a great start to the new financial year. So I'm probably not actually buying, I don't think, any of those ones today, but one, I prefer buy on a down day, basically, and I don't think that we're out of the volatile waters yet. But one that I did buy recently, I think last week, is a company called Cogstate, which I've talked about before. And, it's not a huge holding for me, but I do think it dropped to pretty attractive levels quite recently, and it hasn't come up too much either. Basically, look, the story here is this is a company that's profitable. It makes an EBIT profit. I think it's actually previously not had to pay tax, but however, should be some tax coming forward. And then they are forecasting, a minimum of, around maybe 10 million EBIT for FY 2022. And so I think that they're a profitable little software company. Essentially what they have is software that measures people's cognitive ability. So as you can imagine, clinical trials for Alzheimer's and that kind of thing have traditionally been more in person, but in the last couple of years, it's been more, remote testing for testing these drugs, of which also, there are a few new drug candidates for Alzheimer's that are again driving this kind of activity in this area. So you could think of it as a medium-term tailwind. In some ways, it reminds me of Appen a few years ago. As you can remember, Appen was, selling the tools needed for this explosion in machine learning. By the tools, I mean that raw data. So as the boom happens, there's a lot of demand for this kind of thing. Well, in their clinical trials business anyway, Cogstate is selling the tools needed to sort of go forward with this boom in potential Alzheimer's drugs that we're seeing at the moment. So there is some risk in the long-term thesis there that I also just wanted to mention.
Okay, interesting. You know what happened with Appen, right? Really has fallen out of favor
exactly. That's
in a downgrade cycle.
Exactly. So, of course, the thing that I didn't say, but it goes without saying, Appen had this boom and then it started dropping away, and the share price, looks like a mountain with a steep up and then steep down. So that's what could happen to Cogstate as well. That's the risk in this kind of business model. But also, you could also argue that they've got more recurring parts of their business in the sense that they also can do testing to help diagnose people for Alzheimer's and that kind of thing. However, I did want to flag that risk because that's why I say it's more a medium-term thesis.
Okay, got it. Thank you. So that's what Claude would buy, and he is buying. Perhaps not today. You would prefer to do it on a down day. And we know just past noon here in Sydney on the Friday that the ASX is having a pretty good session at an index level, up by 0.7%. Hey, Luke, I know you're not a big fan of the rain, but the sun no doubt is shining up there in Nui as well. So are you in the mood for buying? If so, what would you be picking up?
Yeah, look, as Claude alluded to, the index has been okay to start the financial year, but where we play, I think the tax loss selling we had in that back half of June, as soon as we've hit 1st of July, it's been a very strong week or so for the micro caps, especially those who are beaten down. Look, like Claude, I like to put my money where my mouth is for stuff like this. So I've brought the last stock I actually have added to in the Merewether Capital portfolio, and it's a business called Smart Parking. Now I've actually written a blog about it on the website, so I'll give that a quick plug, Nadine, at merewethercapital.com.au. But in a quick nutshell, these guys provide automated number plate checking for private parking lots. So previously, where you've got shopping malls, hospitals, airports, places like that with big parking lots, a lot of the time they're manually operated, and it's more of a deterrent rather than a revenue generator, because it's just so difficult for a person to manually monitor lots that big. So Smart Parking offers obviously an automated process to that, generates a much better return for themselves and for customers. But what I like about this business is it's tied a little bit to that sort of reopening, I guess, or relaxation of travel restrictions, particularly in the UK, as obviously you get more cars on the road, more people out and about. Trades on about 5 times, my rough estimates for EBITDA this year, and that's a true EBITDA. It's a metric I don't entirely like for a lot of businesses, but it's a very capital light business. Once they roll out a set of cameras, there's very little ongoing spend, so they generate very good cash flows on the back of that. The big risk this business faces is regulation. And so I actually, a bit like Claude, I'll actually sort of reference this business to another sort of separate sector, but a comparison that I see, and that's the salary packaging guys like Macmillan Shakespeare and Smart Group, where regulation has always hung over the valuations of those stocks. So as shareholders, the returns that you receive is very much from the earnings growth of the business and any sort of capital returns they can give you. I expect Smart Parking to be the same. It's a sector that will always have the threat of regulation over it. But unlike Macmillan Shakespeare and Smart Group, where they are today, Smart Parking is very much in that earnings growth phase. I expect they can maybe double or triple their earnings over the next few years. So shareholders can still do really well, even if that sort of terminal multiple is never going to be more than maybe a 10 times EBITDA or an 8 times EBITDA. So it's the most recent one I bought. I've got a write-up on the website. So yeah, that's my Friday buy.
Yeah, great. So Cogstate and Smart Parking, CGS and SPZ for those playing along at home. And speaking of those with us at home, these are the companies we'll be discussing in the next half hour or so. One of them might be what you've asked us to take a look at. So Audinate for Tamsin coming up, Credit Clear for Nicholas, Artria for Diana, and we've got Kogan on the list as well as Soraya Resources. So very wide and very different sort of companies to take a look at in the next little while. So let's get going. Let's start with Audinate. Audinate is for Tamsin and writes in to say, I'm not invested yet, but it's been on the watch list for a long time. Really regretting not buying it at around $6.50. So wondering what the game plan could look like from here. And the context is, wants it to be a small to medium part of the portfolio. Thanks. So we'll start with you, Luke.
Yeah, look, this is a really high quality business, Dean. Probably one of the highest qualities in that sort of what I would term mid cap space, maybe between sort of 500 million to maybe a couple of billion market cap. And you see that in both the product metrics they put out as the lead they have over any other competitors in their industry. And then where you see it come through in the financials is the gross margins this business earns, high 70% gross margins for what's primarily a hardware business. They're developing some software in behind that, but primarily hardware is exceptionally high gross margins, is always the sign of a dominant business. So these guys are looking to digitize that audio-visual industry. So instead of having all these cables that run to various modules and speakers, whatnot, it's all controlled by traditional, I think, Ethernet cables, and then a digital controller sort of sends sound to where it needs to go, and to make sure it recreates that non-digital sort of experience we're all used to. So these guys, their end customers are the likes of Yamaha, Bose, and they're selling their Audinate modules into their products, which obviously then go to end users. So what's hit Audinate? I'm sure people who are a bit closer to the story are well aware is the chip shortage has hurt Audinate as a first order effect, where they need chips to produce their Dante modules. Dante's their leading product. But then also their customers are suffering from chip shortages as well. So you get the second order effect of chip shortages really sort of hurting this business. Now, they came out recently in the fourth quarter and essentially we'll wait and see whether it is the end of the problems they've been facing, but they've guided to a record revenue in the fourth quarter. In a bit of a roundabout sort of way. They didn't really shout it from the rooftops, but if you sort of back out the guidance they gave, you can calculate it's going to be a record quarter for them. So it could be starting to signal that they're seeing the impacts of those issues subside, which is why it's bounced so heavily off that sort of 650 level that Tamsin was looking at. So, look, for me, there's no doubt if I look at the quality of the business, the trajectory for growth, it ticks every box. The question comes down to valuation, and I think this is one where, Nadine, we've discussed a bunch of stocks like this recently, and it's about the time frame you take as an investor. I think Audinate's one where if you can genuinely be a long-term investor and hold this for maybe 5 to 10 years, you could make significant returns off this stock if they're able to execute the growth that they're trying to do. They've got a very dominant position right now in their market. And to me, despite what's happened to the broader market, to loss-making businesses and cash-burning businesses, it makes complete sense for this management team to reinvest every incremental dollar of gross profit into sales and marketing and growth because they've got that lead. They just need to make sure that they maintain that and they grow with that industry as sort of digital overtakes the traditional metrics. So, look, I'll be optimistic because, spoiler alert, there's a few in the list that I'll be much more pessimistic on. I'll be optimistic here and say buy, Nadine. But again, it's for that long-term investor. There's still maybe noise around that chip shortage. There's still going to be issues around valuation and what's happening with treasury yields and things like that. But if you can genuinely take a long-term view here, I think these guys are building something special with this business. And it'll be very interesting to be a shareholder on that sort of 5-10 year journey, I think.
Got it. Thanks, Claude. Do you see anything different about perhaps entry points or when you would potentially buy Audinate if you were Tamsin, wanting to have a small to medium sort of holding in the portfolio? Or do you generally agree with Luke?
It's a tough one. So I looked back over my notes, and when I covered the half-yearly results, and my idea hasn't changed much since then, I wrote that, I like the company. I can, Luke's just given us a great summary, so I won't repeat that. I agree with, what he said. But at these prices, which it was after results pretty much, I basically wrote, look, I like it. I would potentially buy more, but I'd like to do so at a lower price. Now, when push came to shove, when it actually did drop below $6, which was an attractive price, I didn't end up actually buying some more on the recent dip. So, like Tamsin, I actually missed it as well. So I feel you on that one. However, I guess the difference between us is I actually already own Audinate shares, and I actually was just looking in my notes, and I actually first bought them in March 2018, and it was under $3 share price. So I've traded them a little bit over the years, and I have a much smaller position now, and I am looking to increase that position. But yeah, look, the $8, I have paid $8, by the way, previously. I think so I'm not saying it's out of, the realms of possibility. One way you could approach it is if you didn't own any, you could just make a small initial position and start sort of averaging in. And that means perhaps you won't feel so bad if the share price goes up, but also it might remind you to actually buy when it does go down and drop down. It doesn't always work, of course, but that would be a reasonable approach. So with the caveat being that for me personally, as someone who already owns shares, I'm actually not buying anymore, and it is quite a small position just because I do think it's quite expensive, and it's something I'd be looking to buy on a little bit more pessimism there in the share price. But having said that, I'll give it that little buy just because if I didn't own any shares, I probably would just buy a small amount just because I think it is, to quote a friend of mine, a monopoly in the making, and there aren't many of those in the ASX that we look at. So I like it. Okay,
so there's some information for you, Tamsin, and I'm going to call it a buy from both of my guests today. So it will be put to the investment committee. Also, just as an aside, we do have a new episode of the investment committee up online. If you haven't watched it yet, you should make the effort to go do so. So it's there at ausbiz.com.au and also via the app. All right, let's get to the next on the list. This is Credit Clear for Nicholas, looking for an opinion on the company. He thinks it's a good one and thinks that the macro environment will be a tailwind for the company. Reckons they're good operators on the verge of profitability, but still flying under the radar of big instos. What do you think, Claude?
Credit Clear. So actually this one, it was one of those moments where I sort of started, quite skeptical. But then as I looked into it more for this show, I think that there's definitely something there. It's worth watching. Now I think the gist of it is here. What I really like about it is this is essentially a platform company that sort of provides the tools needed for other companies to collect on debts. So that could be, even like a private school trying to get the parents to pay up the fees on time, and Credit Clear have a platform that they could use to like send them texts and stuff like that. And Credit Clear, sells that platform, but also sells that connectivity as well. So it's not a super high margin software as a service business. In the collections part of that business or the legal service part of that business, you have a gross margin that's nowhere near that software as a service 80-90% level, like more closer to, I guess, 60-70%. I didn't check that, but that's where the ballpark is. So that means when we look at the current price based on their May update, it's about 4 to 5 times. You'd be paying 4 to 5 times, I guess, their revenue based on their most recent May update, which is not crazy, just because they did say they've just gotten into operating profitability. So that does suggest that they're on the path to break even, and that's why I say this is definitely one worth watching. I thank the questioner for putting it more on my watch list. However, the catch for me at the current prices, the reason I wouldn't be buying, even though I think that this actually could be a buy one day, is that you've got to remember it's actually, the market cap is a little bit bigger than what it says on CommSec because it's got those escrow shares. And so I would probably wait until we get through this escrow period. Let's see if those escrow holders are looking to sell on the market themselves, or if they're actually long-term holders themselves. That'll give us a little more information about, where the company might go in the future. In the meantime, the reason I like it is because I guess if you have tough economic times, there might be more market for like sending people text messages asking them to pay their bills. So that means that this could be like a really quite cool in the fact that it might be kind of counter-cyclical, and that stuff is always worth studying.
Thank you. And Luke, what do you think about Credit Clear?
Yeah, look, I actually agree with a lot of those points. It's one that's sort of been on my radar a little bit as well without digging really deep into it. It's only a relatively recent listing. And the other thing is they made a large acquisition late last year, I think in December last year, actually. And that acquisition was actually for a business sort of larger than Credit Clear, like more revenue and a decently profitable business compared to Credit Clear, which was still loss-making. So the timing on that acquisition was actually really, really good because it meant that they made the acquisition when capital markets were still quite healthy back then at the back end of last year, but also coming into this period where, as we know, so many sort of high growth loss-making businesses have been absolutely hammered. They're pretty close to reporting an operating profit, largely because of that acquisition they made. So, look, I've got it on my radar. The acquisition was for more of a traditional receivables management business, whereas Credit Clear, as Claude alludes to, is targeting that sort of digital software as a service business, much more high margin, and that's the sort of business you want to own. So for me, I've got it on my watch list. I want to just make sure that digital business is growing the way I want it to. And the other thing, I agree with Claude on those escrows shared. And the other one is, relatively new listing. They've also had the CEO change as well. So just a couple of things that are sort of, I've got on the watch list and if the time's right or there's some execution or the price is right, it's definitely one I would take a real close look at and potentially buy. But just a few things keeping on the sideline, but definitely watching for now. So I'd hold it if you're there, but if you're someone else, you could definitely wait for this next report. I think that'll be the theme for a lot of these stocks, Nadine. Just you've got a reporting season coming up. There's no need to sort of jump into some stories right now.
Thank you. Let's go to the next on the list for Diana, because this came in for you boys specifically. Would like an opinion on a small cap, Artraya. I think that's how you say it. AYA. I don't know why I find that difficult. Is it a watch, a buy, or an avoid? I don't know a lot about the company, but it is AI support for coronary artery disease from what I can see. Luke, give us your assessment. Buy, hold, sell.
Yeah, well, I mean, my comment just then on Credit Clear was, the timing of their acquisition was good. These guys, they only IPO'd late last year. And again, this is an IPO that would not get away in this current market. So, the timing on that, kudos to management. They've got cash in the bank and looking to execute their strategy. This is very early stage. This is pre-revenue. And this isn't a drug or a sort of biotechnology device. This is software as a service. It's quite rare to actually see software businesses come to the ASX pre-revenue. I mean, normally some sort of venture capital business, is providing funding for these early days, and they might come to the market with a few $1 million ARR or something like that. So you're very much investing in a concept. But when I look into it, again, I'll caveat, this isn't one that I would buy, Nadine. It's not my style of investing. But there are characteristics to this business where if they can execute and more importantly, show the efficacy of their software for what they're trying to achieve, it could do really well. So the main reason why is it's software to try and detect plaque in the arteries around the heart. And that build-up obviously can lead to heart problems and is a leading cause of heart attacks. Now, the software just goes over the top of existing CT scans. So you're not asking these hospitals and your customers to roll out additional CapEx, additional hardware. It's purely a software, most likely a usage-based model. So if they can prove that this software works, I could actually see the take-up being quite rapid. And it can be very capital light, given that you're not having to do big rollouts and things like that. You can sort of just have your software. It's all cloud based. Have a customer onboarded relatively quickly. So, look, there's things to like about what they're trying to do. It's so early stage, and I've got absolutely no expert insight into the software or anything like that. I can't even begin to make a call as to whether there's some sort of competitive advantage there. What they're trying to do. Look. They've got 40 mil cash in the bank, burnt $4 million last quarter, so there's a decent runway there. The other thing I noticed for these medical sort of guys, it's not just R&D and sales. You have to you've got to rub shoulders with the right people. So they've got their medical advisory consultancy board, which has 8 US doctors on it. These are all sorts of things you have to pay for as well. So it's not for me. Look, if you're very high risk, definitely have a look at it. If you're there, I would hold it. Nothing's changed. If you've bought it, nothing's changed other than the market, I suppose. Mm-hmm. So it's a hold for that purpose, but very, very, very early stage.
Got it. Thanks, Claude.
Yeah, so I agree with what Luke said, but I'll also just add more as a general thing is I'm guilty of it. I've done it before. But generally speaking, buying zero revenue companies, it's just more speculation on narrative and I guess like market flows and what's happening in speculative med tech companies on the ASX than it is really on anything else. I think it's just if it actually is going to be a big thing, then there'll be a great time to jump in on it after like it's got its first $1 million in revenue or something like that. So definitely an interesting story and one to watch. And I have been guilty of speculating on these kind of things in the past, but it's not been a profit. It's not where you make your money in my experience. It's just almost a zero-sum game. And you don't have enough fundamentals to get an advantage over the market because you're just trying to, I guess, predict sentiment flows. So yeah, for me, I just think it's too early stage.
Thank you. That's your answer, Diana. All right, let's get to number 4 on the list because this is a fallen angel, you could say. Kogan. KGN is the ticker code. No context from Lily, but I think we know what's happened. Huge COVID winner. Things have taken a turn. Is it a bargain now, though, Claude?
Well, is it a bargain? It's hard to say. So this is not a business that I like to invest in. I never have, obviously it's had a meteoric ascent and then back down. Just because I think there are other retailers and also online retailers that I'd prefer. I'm not a massive fan of, I guess, like the management track record in terms of how they remunerate themselves and all that sort of thing. So for me, it kind of just falls down on that criteria as it's not in my investment research, since I put a massive emphasis in my investing on assessment of management. However, having said that, look, I think that it survives as a business. It's got a value. Look, the analysts forecasts out for 2025, so I guess looking through a bumpy ride, are suggesting EPS at around 50 cents per share. If that's true, that'd put it on a PE ratio of less than 10, and I wouldn't see it being worth less than 10 times earnings. So, of course, I just thought the reality of this business is it's been quite up and down over the years and goes with the economic cycle. So it's pro-cyclical. So, if you bought it now and just held long enough, I think you'd probably get a better exit point and you'd probably make money. But then again, you might also want to try and time it a little more. A lot of people think that there's a real risk of a recession coming up, which I think would be bad for Kogan. So it's quite possible that sentiment could get lower with this one. So I wouldn't see even though I would never really personally buy shares, if I was going to buy shares, it would more be like a little bit of a pro-cyclical punt if I thought, we're in the darkest days of recession and things would be getting better in the near term, then I could see this being super leveraged to that cycle. So that's how I look at it.
Thank you. Luke, do you look at Kogan favorably?
Look, when it's fallen so far, it's obviously more favorably than where it was, but I agree with what a lot of what Claude just said. And look, the note I jotted down, Nadine, is like these guys, they extrapolated those COVID trends way too far. And look, maybe that's a mistake a lot of people made, investors and management teams for a few businesses. But as an example, like the business has doubled since pre-COVID, like from a revenue point of view. But their marketing costs and their people costs, as they put it, were both around $9 million in the first half of 2020. And they're now $41 and $46 million respectively. So more than quadrupled, despite the business doubling. So, that's where that operating leverage just hasn't come through this business. Now, you read the last report and there's management commentary about being overstocked with inventory, looking to sort of wind that back a bit, looking to control those operating costs. And so there's a fair chance, that maybe the next few quarters could actually look pretty good from a reporting point of view, given that, you might start to see some of that operating leverage come through. But as Claude points out, there's just so many clouds now over the consumer that even if the business is able to do those things to its cost base and sort of wind back the inventory, the excess inventory they've got, you're probably doing that into the face of a consumer pulling back. Certainly from a goods point of view, we can see that in the ABS numbers. So look, this is another one, a bit like CCR before, Nadine. I think you're about to have, they usually do a quarterly update, so I suspect we'll see one in the next week or two. I wouldn't be jumping in until I saw that. And that may be a catalyst where if you see some things that you like in there, for me, that would be around those operating costs. Then, yeah, it's one you might revisit because the chart says it all. There's, every business has a price. And this one, it's obviously closer to that price now than where it was in those heady days of COVID. So I would hold it if you're there again. But if you're on the sidelines, definitely wait a week or two. Wait for this quarterly update and just make sure that what the business says they're going to do actually comes through.
Thank you. Let's get to number 5, shall we? This is for Braden, saying it'd be great to get Claude's and Luke's opinion on Syra Resources. So it's a small cap, yes, but it is in the battery materials space. And the viewer is wondering if it could cement itself as one of the only active anode material suppliers externally to China. So there's some context in there. Claude, we'll start with you because you were name dropped in there. Are you buying into the battery materials craze, really, is what it is?
No, I'm not. I tend to let most crazes go through to the keeper. Not all crazes. Some I get sucked into and hopefully you make some money. But at the moment, we're definitely having a bit of a moment for excitement about the future of battery energy systems. And I don't think that they'll necessarily be one of the only suppliers to China long term. I think China usually sort of thinks strategically about these things, so they try to make sure that they have multiple suppliers for most things that are strongly in demand. So I wouldn't be too comfortable about that long term. But what I really do like about Braden's question is he's talking. It's not just a craze. It is also a genuine long term tailwind, right? So zooming in on that. In a couple of years, Syrah is forecast by analysts to make a small profit. And at the moment, it's supposed to be crossing over to break even around now, and we'll see about that. I am a bit skeptical, but supposedly in the next couple of years, it's supposed to make a profit. I would look to probably join the story then, and you might even also have a better opportunity in the sense that whilst the battery materials boom and the long-term demand for that is most likely real, and that is probably a multi-decade or a decade-long tailwind, I don't think that the level of excitement around that will be sustained at current levels for the whole of the 10 years. So there's probably some time whilst we see this tailwind where you can actually jump on board some companies that are going to benefit from it that are actually profitable at the time, and you're probably not paying an insane multiple of earnings. So that's a fancy way of saying that it's just too risky for me at the moment, but I love the tailwind you're looking for. And I'd add as a caveat there, I'm not an expert in resources companies, so perhaps take that with a grain of salt.
Yeah, Luke, where's your expertise lie when it comes to some of these small resources plays and what the future could potentially hold? Because, again, I've said it on air before. I've had so many conversations, particularly in the last week, just really emphasizing that out of any of these sort of cycles that we go through with particular metals and minerals, there's really only one, maybe two ultimate winners out of the story.
Yeah, it's a very good point, Nadine. You're right. And look, so you know me, like resources isn't my forte, and that's why whenever they do come up, I'll always favour the profitable producers, as Claude alludes to. It just gives you something more fundamental to fall back to. Cyra's on their way there. Like I hadn't looked at this business for quite a while. It was a very controversial business a few years ago with some short reports and things like that. So it was always sort of on my radar to some degree. Look, they've got some real production going on, ramping up quite nicely, as Claude alludes to. People who cover the stock see them tipping over into profitability pretty soon. On the numbers today, it looks like they're a little bit off that, but with these things, and particularly the prices you can achieve, as we know, commodity producers can very quickly swing into profit if conditions are right for them. I think the appeal of Cyra, and there's a few other businesses on the ASX when you read their presentations, is acknowledging that, these battery metals, rare earths, there's materials that are very controlled by China, and you have jurisdictions, particularly the US and Western Europe, that are trying to obviously find resources outside of that Chinese control. So that's where Cyra is positioning itself as, a non-Chinese graphite resource and one of the biggest in the world, for that sort of criteria. But for me, again, I prefer the numbers. Like as Claude alludes to, you're playing into the narrative there, and that narrative can work for certain types of investments at certain periods of time. But as you come into this period where you're now in production and you're ramping up, the numbers need to do the talking for you. So I'd sit on the sidelines with this one and just watch it. My one note I did have for Braden, though, is if you're looking to play this graphite space, there aren't many, and that's the appeal of something like a Cyra. There's not many other exposures on the ASX to graphite, so it's the one thing that will always have going for it from that point of view.
Got it. So that is not one for you at this time. Look, we are at the halfway mark, so let me just summarize what we've learned. 2 buys on this Friday. It's Cogstate for Claude. Prefers to buy on a down day, but keep in mind the medium-term risks as well. He likes it for now. Smart Parking, very good cash flows is what it's got going for us, according to Luke. But again, it does have a regulatory overhang potential, so keep that in mind. But a couple of buys for you. There you go. Now, another buy, Audinate. So it's really, really high quality in Luke's view. And look, Claude is looking to increase his position. He would prefer to do it cheaper, but he would also be happy to buy at today's price just a little bit. So small position to start averaging in from here. He too thinks it's a quality company. Credit Clear is a hold for Luke. It's on his radar, but not a buy just yet. He's thinking along the same lines as Claude. Wait for that escrow. Wait for shares to be removed from escrow to see what the directors do with that. But it could potentially be a buy one day in Claude's view. Artrea, this is not a buy for either one of my guests. High risk, too high risk for Luke. And Claude just doesn't buy zero revenue companies. It's a good way to lose money. Kogan, it's an avoid. There's many reasons why Claude wouldn't buy it, but particularly because the cycle, where we are in the cycle, and that's the same story for Luke. He says there's a cloud over consumers. Why would you buy a consumer leveraged company? And you just heard the guys talking about Cyra Resources, so that is too risky right now. Okay, let's get on to a bit of a summary for the portfolio. This is picked by the investment committee. You can watch it, as I said, on ausbiz.com. Tyro, Qantas, Frontier, Digital Ventures, Tabcorp, and Steadfast were removed. Bapcor was added to the portfolio this month, and we're now holding just over 10% cash. So we'll see what we do with that next month. And so far this year, we're down by about 6% on a cumulative return basis since its inception on March the 1st. Keep sending your requests. Companies like Audinate that get 2 buys are then put to the investment committee, but they remain in the call portfolio as well.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
And over the next few minutes, we'll be speaking about Aquis Entertainment, AQS, Tesserent in the cybersecurity space for Richard, Paynecheck, as well as Hazer Group, new CEO there, and Money 3. Let's get straight to it. My guest hosts this hour, Claude Walker from A Rich Life and Luke Winchester from Merewether Capital. I'm pretty sure I messed up your name somehow earlier in the piece. I'm pretty sure I said Claude or Luke Walker, whatever. Claude, I'm talking to you this time.
So close to Luke Skywalker.
Yeah, I think that's it. I totally think that's it. Aquis Entertainment. So what are the views on Aquis after it offloaded one of its casinos? Now, at A Rich Life, bit of an ethical filter over it. Would you be more interested in Aquis Entertainment now, Claude?
Yeah, I guess so, because I guess that the thesis, is changing for this. So obviously, because it's actually the operator of Canberra Casino, which seems like its main business, I have never actually looked at it before this show. And look, the story is that it is slated to sell its casino for $60 million. Of course, that's not guaranteed to happen. But I imagine that is the questioner is probably thinking about that in terms of the thesis. And I guess the thesis would look something like the fact that I think it's around a little bit less than 30 million market cap at the current price. It has perhaps net debt of around 25 million. And if it gets if it gets 60 million for the casino, I guess it might be trading for less than its assets. I think that's probably the thesis. And I would want to be very sure of all those numbers before I invested. But it doesn't seem like a crazy thing to do. However, I would just warn and say often a company that is essentially then a holding company or a cash box, often that can trade below actually its genuine value. So even though I'm not poo-pooing this idea, I think it's interesting thinking. It's not something I would ever do myself, at least not in the rarest of situations where I had most incredible confidence in management. And I just don't know these guys and haven't followed them for a long period of time. And I would need to have followed them for years to have that kind of confidence. So for me, it would be a pass.
Thank you. What about you, Luke?
Yeah, it's an interesting situation because I'd never looked at it either, I must admit. And my reading was similar to Claude's, which is it's to only purchase the casino. So it's not to purchase, Aquis as a listed entity. You're not getting a cash for your shares or anything like that. So it is the only operating asset the business has. So effectively, Claude's right. You'll be left with a listing, which has a value. Usually they trade between maybe $3 to $5 million. And then, some other business will be vended into that. My rough numbers were similar to Claude's. You've got a 60 mil bid. I've got the EV around that sort of 55. So, there's a little bit of meat on the bone there, plus whatever value is left over. That's just on a half-hour view. So I agree with Claude. Stuff like this is pretty complex. You definitely want to make sure you got your numbers right around the actual correct enterprise value of the business and what is remaining. There's no liabilities or anything like that remaining afterwards. The other note is there's actually two bids I noted. So you had one initially and then another one come over the top. So that gives a little bit more sort of safety that something will likely go through. And my final note was it's actually very illiquid, Nadine. So there's probably not much that anyone could really do anyway from an arbitrage point of view. You probably struggle to get a decent position, and if you're in there, the next highest bid was quite a way down. So it's even difficult to sort of take some profits and move on. So you're probably just forced to wait there until the transaction goes through and some sort of capital return comes back to the shareholder. But I actually think that's quite likely to happen. Unless there's some sort of regulatory approvals. We've seen that with Star and Crown have issues. I don't know about Canberra Casino, but that's probably the biggest hurdle the business faces. But yeah, otherwise, look, there's probably not much you can actually do from as far as a buy, hold, sell, to be honest. I'd just sit there if you're an existing holder.
Got it. Thanks. Okay, guys, let's get to Tesserent, TNT. This is for Richard. He reckons that cybersecurity looked like a sure bet or a logical sector, at least when it comes to growth. So he bought a small parcel about 18 months ago at 40 cents, but share price has not been doing well since. He sees it at around 10 to 12 cents, maybe bottoming out. happy to sit on it long term because he's got such a small piece, but he's wondering maybe he should add at these levels. Luke, I'll start with you for Tesserent.
Yeah, look, these guys play very heavily into that cybersecurity theme. They came to the market a few years ago and made it very clear that they were going to roll up that space of these smaller cybersecurity contractors. One thing that's worth noting, I think this gets sort of mixed up when people talk about Tesserent, is there's very little IP in this business. They're very much like consultants and contractors to enterprise government. So, customers will use them to create a cybersecurity suite or make sure that their operations are secure. But there's no Tesserent software that gets rolled out. There's none of that high margin, that Claude and I both love in businesses because it's so high margin and scalable. It's very much a people business, contract based, but nonetheless, they were the only sort of player on the ASX rolling up the space at the time and getting some very good, essentially multiple arbitrage from that public-private market, which plenty of other spaces have done in the past. 13 acquisitions in the better part of sort of 2.5 years is a lot, and I think you're sort of seeing some digestion issues in there, and that's come through in the share price. The last couple of results seem okay. They break out organic and acquisitive growth, and the organic growth looks okay. I didn't dig into those numbers to sort of see their calculations or anything like that, but it looked okay at face level. The one big red flag I did see was actually just in that last quarterly report, and the problem was they reported an EBITDA of $4 million in the third quarter, but a negative cash flow of $1.1 million. That's a very big gap between your reported EBITDA and your operating cash flow. You want to see that, pretty much at 100%. To see a cash outflow when you're reporting a $4 million EBITDA suggests something. It's a working capital problem, which could just be a short-term timing issue. That's why it's not an immediate, sell something like that. It's just definitely something to keep an eye on. My other thought is, maybe something around revenue recognition where you're recording revenue well before cash comes in the door. So keep an eye on that, particularly the fourth quarter. I would really want to see that cash come in. If I didn't see that come in the fourth quarter, those alarm bells would really be ringing for me, because it's usually the first sign that a roll-up's going sour, Nadine, is when the cash, the accounting sort of runs ahead of the cash coming through in the business, and it's always it's always that first indicator that something's potentially going wrong. So definitely keep an eye on that if you are a holder. If you're on the sidelines, again, I come back. It's been a common theme. I'm sorry, but just wait for that next result. As I said, I saw a big red flag in that third quarter. I wouldn't touch it if I was on the sidelines until I just got that confirmation that things were actually okay in the fourth quarter coming up.
Thank you, Claude. What do you think?
I think that Luke gave an excellent summary then. I guess I'll just build on top of that because I generally agree with it, by adding a sociological perspective and then also maybe just talking about valuation a little bit more. Sociologically, around 18 months ago in that period, we were definitely in a bit of a bubble about cybersecurity. And, that was also led by big cybersecurity stocks in the US. And Tesserent was really talked about a lot on, various social media forums. And it was a bit of a crowd favorite. And I think just it's good to be able to recognize that when, this big sort of another one that happened to the same time was AR9, and they've both fallen a long way. Tesserent is definitely, in my opinion, the better of the two. But look, over the last 9 months, as this is another way of saying what Luke said, but if you look at the last 9 months, the operating cash flow is about 3.2% of the receipts from customers even. So not even talking about the revenue stuff. And that to me shows that it's a pretty bad business. It's not a high quality business at all. And then, because it's over 100 million receipts in that time, right? So it's low margin. And then you've got, even if you just sort of use their EBITDA, which is not exactly the best measure of profitability at all, it's around 14 times EBITDA, based on a best guess looking at the last 4 quarters. So that's not even cheap. And we're talking about it actually probably deserving a really low EBITDA multiple, and EBITDA multiples not being a very good valuation thing to rely on anyway. So to me, it's just, I wouldn't be buying more, put it that way. Like, it may go up from here, it may go down, but it doesn't look obviously cheap to me. And I think it was just crazily priced at the peak.
Thank you. Got it, guys. That is Tesserent. Let's move on to the next, which is Pain Check for Damien. getting experts like Claude and Luke to take a look at this medtech company transitioning to a government-subsidized trial to commercial licenses. So, wondering what or how that you might sort of look at a pain check and what metrics you'd be looking at to decide whether it's a quality investment. Is it a buy, hold, sell today? And you may as well throw that in there as well.
Which one of us? Sorry.
Oh, apologies. I'm going to go with you, Claude.
All right.
The power I have.
I've got a bit of an unusual sort of way of critiquing this one, so I'll go with that, and probably Luke can fill some of the gaps. But basically, I just wanted to talk about what this one does. So, look, it doesn't have the financials to attract me, put it that way. But even if it did, even if this was a bit of a go-go stock and it was a bit bigger and a bit more proven, I still have questions because, essentially the idea here is that they have like, a technology assistance via an app for you to be able to tell if someone's in pain. Now, look, I guess the better way of applying that has had some traction is with old people. But one thing I really wanted to zoom in on is this idea that they put forward in their presentations that people, babies can't communicate they're in pain. So you need like an app that uses their facial expressions to tell you if they're in pain. I'm just really skeptical about that. Like, I don't know. I personally don't know of many parents who's ever said to me, my real trouble with, that I'm having with this less than 12 months old baby is that I don't know if it's in pain. Just practically speaking, the way that it's been for most of me and my friends is that if the baby's unhappy in any way, they let you know. And, there's only a few things that it can be. So you either like fix whatever the problem is, or if you can't fix the problem is, then you might start worrying it's in pain. I also think there's sort of some instinctual thing between humans that mean that you have a good sense of if your young child is in pain. It's like you can almost distinguish between their cries. So I really don't believe that is actually a problem that humans face. And for me, it seems like a dark future if we need apps to be able to tell if our own children are in pain. And, my final point here is that, they say in their things, they're well positioned because of, all of these kids that get immunizations under the age of 1. But I think that I've never heard that many parents that are really that worried about the momentary pain or any kind of pain really arising from those childhood immunizations. But certainly those few people that I do know that do worry about the pain that a needle might cause for their young child, they also worry about putting their children's face on technology and uploading it to whoever. So I just feel like the Venn diagrams of those two groups pretty much overlap. And so I can't see that there'll be that much demand for this, but perhaps I'm wrong.
Okay, got it. So if you fundamentally don't believe in what the company is doing, then you're not going to invest in it, right? So Luke, what do you think about pain check?
Yeah, look, Claude highlights a lot of issues I saw. I tend to agree with that. I've got a couple of young kids in the team. I think they definitely let you know when they're in pain. Look, Damien, who's written it in, he asked some very good questions alongside it. To me, this is just a classic watch list stock. You don't have to be there early. Like if these guys really do what they want to do, it'll be a long and lucrative journey for shareholders. There'll be plenty of opportunities to get on as they're further along that path. The biggest issue I saw though was they say they have a 60% market share in Australia, which to me I was actually very impressed by. I mean that's some real traction in the areas you're trying to move into. But the expected ARR of that, because a lot of them are on trials, they have to convert them to customers, is only 4.3 million. So you're talking about if you manage to get 100% penetration in Australia, your ARR would be about 7.5 mil. Right now, the cost base of the business is 10. So, even fully penetrating your Australian market, you're still a loss-making business. So you're asking me as a shareholder to then believe that international expansion is not just guaranteed, but like required to earn a profit as a business. That's a step too far for me. I would need to see this business be profitable at a core Australian market before I could even think about stepping in for international growth. So look, watch list it for sure. If you're there, you're there for the promise of the technology. I don't think anything's changed there. As I said, it's good traction and their customer list is impressive. But from my point of view, and Claude's the same, when you factor the numbers into it, I can't make the numbers work at this stage of the business's life. So I'm on the sidelines for this one.
Okay, there we go. Got that one. Hazer Group, HZR for Die. She purchased at 98 cents. Been a pain trade ever since. But she did purchase with the intention to hold. A new CEO took over this week, or at least was announced, and share price had a bit of a bounce. Do you know anything about the company, the new direction the CEO will take it likely, Luke? And would you be holding and continuing to hold?
I did see the new CEO was announced. I didn't look too much into that. This is one that it's been around for a while, a few years now, and actually popped up on my radar, I think back in like 2019 when they had a agreement with Mineral Resources, and Mineral Resources does this quite a bit. They'll invest, either invest in companies or have agreements with a lot of sort of speculative resource companies or technology companies. And so it sort of popped up on my radar. Keep an eye on this because the guys at MinRes are very smart, and if they see some potential in this technology, then there could be something there. A couple of years go by, MinRes walk away. And to be honest, Hazer sort of fell off my radar at that point. My view was sort of that, if MinRes couldn't see anything with what they were trying to do, there's probably nothing there. The tech looks interesting. So as an explainer, they're looking to take LNG and through a process they call the Hazer process, turns that into pure hydrogen and also synthetic graphite. So, you can see why people are interested straight away. You're targeting two hyper growth segments there. But it's all about the efficiency of that and whether it's commercially viable. For me, when I saw MinRes walk away, it sort of, it fell off my radar at that point. They signed another MOU with a Canadian company a few months ago. So, maybe there's, again, another sort of light at the end of the tunnel that someone else may look to commercialise this with them. But for me, pre-revenue, again, too speculative. I think it's another classic watch list. If the tech works, you'll have plenty of time to jump on this story at some point.
And that's the thing, Claude, isn't it? Is that hydrogen, green hydrogen in particular, I mean, it's a long road before it's going to be used in any big commercial application. Yeah,
that's right, Nadine. This is a company that doesn't, have an existing business. It's more just, an idea for a business, and that's fine. I can completely understand the allure of this kind of thing, especially when it could solve big environmental problems. That's actually how, many years ago now, I first started investing in some companies like Hazer Group that had no revenue, and they had a great story for this technology that was going to solve some of the big problems of our time. And what I learned from that experience in those very, early years starting out as an investor, like when I was just still at university even, putting, my $500 in a stock that I had left over from travel, that it's not good to just invest with my heart. I have to also have some harsh reality about valuing the company. What are the likelihoods of success? How is the cash flows of the company going to justify the current price? And it's just basically impossible to do that with these kind of businesses, especially when, the actual thing that they're selling isn't built. It's a different thing if they've got a product and they're taking it to market and they've literally started selling it today. But it's really hard to value it. You can't really do it. That means it's sort of speculation in a way, and it's just a different ball game, and I don't recommend it generally.
Thank you.
I'm saying I'm guilty of doing it, but I don't think people should do it really.
Okay, got it. Thanks, guys. All right, last on the list, Money Me. So, Luke, this was attention you, really, asking for your thoughts. Good history of growth and profitability, according to our guest. Forecasting for 50 million NPAT for FY22 seems cheap in his view. Though, is there a concern about slowdown in new car sales or bad debts? I spoke with the CEO quite a couple weeks ago, I guess. It's up online. The CEO says no, not worried about that. Would you be as an investor, Luke?
I think so. And I think Ben, who wrote it in, he's right. That's the issues overhanging this business. Look, when I worked at my old firm, I wrote a blog post about small business and personal lending companies, and basically highlighted they're terrible businesses on the ASX. There's a reason why the banks don't really touch small business and personal lending to any great degree. The only two exceptions to that was Credit Corp and Money3. So I give them a lot of credit. I think they play in an exceptionally tough space. And I agree with Ben that they have a demonstrated history of being able to grow and be profitable and return capital to shareholders through dividends and all the things you want to see. It looks cheap. The business, obviously, I didn't see that interview, Nadine, but I trust the CEO when he says that, because they're out there with a very strong buyback. They only announced a buyback, a couple of weeks ago, and they've already bought back 10% of the 15 million buyback they announced. So they genuinely believe their stock's cheap and they're buying it back very strongly. There's two issues that I see. One is the macro. Ben alludes to it. New car sales. What will they do in this sort of consumer sentiment environment? And also used car prices, can only go down as sort of, the issues around the supply of new cars alleviates itself. Mm-hmm. The second issue to keep an eye on, though, is Money3 historically has had a very good moat through the distribution to used car dealers. You've got the used car dealer network around Australia, and they would be in all of those dealerships as the preferred financier of choice. Mm-hmm. There are a lot of competitors now, and slip of the tongue. You actually said MoneyMe as the intro. That was the one I was going to raise. MoneyMe are growing exceptionally quick in this auto finance space, along with a few others. And so you've got this potential combination of the yields on your loans coming down just through the competition, as bad debts potentially creep up, which, despite what the CEO commented, they did creep up a little bit in that last report. So, the market may be looking at a bit of a perfect storm for a business like this of increased competition, just as you come into some weakness in your loan book. Look, they think it's cheap. They've had a very good operating history. Ben, if you own it, I definitely wouldn't sell it. I would probably come back to something I've said a few times, Dean. Wait for that annual report. I think they'll come out soon. Let's see if they hit that 50 mil, dig into it, how they got there and all the sorts of things, and we'll make an assessment then. Buy,
hold, sell. We'll have to keep it short, Claude, for Money3, MNY.
Yeah, I guess I'd call it a hold as well. Luke was very comprehensive there. I do also agree in the long-serving management, probably one of the best management teams in this sector. Most of these companies, I would never even say hold. But it's one you're buying for the dividend, and just keep in mind that if you are holding, I would keep a close eye on how the price of secondhand cars is holding up. They, in my opinion, are starting to drop now, and that could be exacerbated in a recession. And that's definitely bad for Money3 because that's their collateral in many instances.
Got it. Claude, thank you. Now, guys, let's just run through what we've learned. Aqueous Entertainment, it is a pass for Claude. It's a liquid. It's a hold for Luke if you've got it, but there's a lot going on with bids, etc. So he's not interested. Tesserant, Luke says wait for the next result, but not looking good. Claude would not be buying into this one. Fundamentally, Paycheck's business model does not resonate with Claude, so he would never buy it. Could be a watch list case for you, according to Luke, but he's not interested. Hazer Group, look, that was a red flag when Mineral Resources walked away for Luke. Look, it's an idea. It's an idea stock. It's pre-revenue. There's nothing happening there. Claude would not buy it. Money3, you just heard them talking about it, and I'll let you go with that. Guys, a huge thanks for your time today. As always, Luke Winchester from Merewether Capital, Claude Walker from A Rich Life. I hope you both have a really wonderful weekend with your families, and we look forward to speaking soon.
Thanks
for having me.
Okay, that's the show for the day. Any stocks you'd like us to cover, you can email us at thecall@ausbiz.com.au. Check out the Call's portfolio, ausbiz.com/portfolio. Stay with us. I'll be bringing you through the small caps next.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
About 70% of Australian businesses were having a problem with democratization of data.
There is still very much a battle, primarily between Microsoft and Google.
Join me each Friday at 2 p.m, where we'll ask the big questions to the country's top cyber experts. Stream on ausbiz.com.au or on demand.
Yeah, just over the shoulder. Yeah.
Managing your own super used to be complicated. Not anymore. With Stake Super, signing up for your SMSF takes 3 minutes and not a single piece of paper. Once you're set, you can invest your super on the ASX and Wall Street, right on the Stake platform. But leave all the admin and accounting to us. That's included in the annual fee of just $990. Take control of your super with Stake Super, Australia's most hassle-free SMSF.
The Pulse is brought to you by Xerilio, cybersecurity experts protecting Australian businesses and organisations so we can all be safer together.
Hi there, welcome to the Small Caps. I'm Nadine Blaney. Well, a bit later on, we'll be speaking with Mighty Craft CEO Mark Haseman after the company signed a beer distribution deal in New Zealand, and it's a Friday, so we always start the drinks early here at AusBiz. First, though, let's check in on the market. Look, the index was doing better earlier on. It's now still in positive territory, up by about 0.5%. Just a bit of breaking news, I think, over the past half hour. The former Prime Minister Shinzo Abe in Japan, has been shot. He was delivering a speech, appears to be in cardiorespiratory arrest, so he is unconscious, I should say. And we were just sort of chatting in the newsroom that it's pretty unusual, highly unusual to see something like this happen in Japan, where there is very tight gun control. I was looking for any market reaction there, but also keep in mind that Japanese equity markets have a lunch break, so they're on hold right now. So we'll keep an eye on some of the market reaction potentially to that event in Japan as this afternoon goes on. But the focus of this program, as we well know, is small emerging companies. These are some of the ETFs that track emerging companies, small companies here in Australia. Look, while the S&P ASX 200 is up by 0.4%, we've got the emerging companies index up by 1.6%, the all small ords, I should say, up by 1.2%. So pretty positive for a lot of those. Well, those small cap investors who have been suffering as of late. Dubber is one of those making good gains. Okay, some of these tech names that have been sold off very, very hard. Whisper is one of them, having an update today. Having a down day, though, is Kronos Plenty. Alcidion in the biotech space, or medtech, I should say, down by about 7.6%. Let's get you across some of the small cap news today. And Terracom's executive chair, Greg Ransley's retiring as a director effective immediately after more than 10 years after founding the company. Shares in the coal miner have been on a tear this year, of course, thanks to soaring commodity prices. With the resources theme in mind, Galileo Mining is in a trading halt ahead of releasing its latest material drill results. Its share price soared in May after its previous discovery of a major palladium, platinum, gold, silver, and copper mineralization, nickel in there as well, at its West Australian Norseman project. So how do you position yourself as a small cap investor in this current market? One day's up, one day's down, and what sectors are worth looking at or looking through? All right, let's get to a lot of the details. Sean Wyke from Wilson Asset Management is joining us live in studio. Sean, nice to see you again.
Great to see you.
Thanks for coming in.
Thanks very much for having me.
Look, I don't think I'm overstating it to say that it's been pretty tough for a lot of small cap investors, particularly since January. Do you think things are going to get any easier from here as interest rates continue to rise?
Yeah, it's a great question. I mean, if we look at the performance of the small cap market over the past year, I mean, the small industrials ended down over 25%. So that was about 16-17% underperformance relative to the all ordinaries. So, clearly we have felt some pain in our portion of the market already. I guess from here, the way we're sort of looking at the market is that valuations in the small cap space are at decade lows. Clearly there are question marks around where valuations should ultimately land given, the tightening cycle that is underway in the US and the implication that has for risk-free rates. But we do think that a good portion of the valuation derating in share prices has played out now. So for us from here, it's really a question of, well, what does the earnings outlook essentially look like? And for us, I mean, what we're trying to work out, I suppose, is with the Fed and, central banks domestically as well tightening into a slowing economy, the risk and the narrative has very much shifted from, I suppose, a concern around where interest rates will peak to, how deep will this recession be if we are indeed going into recession. Our base case is that we are likely to move into a recessionary environment. And so then it's trying to work out how deep will that be? Will it be short and sharp, or will it be more drawn out and prolonged? And, as a result of that will ultimately dictate where earnings land. But for us, our sort of base case at the moment is we think, certainly domestically it will be short and sharp. The economy's in a very strong position. Unemployment's at, record lows. So, yeah, for us in the small cap part of the market, a lot of sectors and a lot of stocks have been painted with a very broad brush. And, you are starting to see a little bit of that unwind, and the market is starting to, I guess, sift through the weeds and start to pick, some of those stocks that look, well positioned to print, good results at the upcoming reporting season. So, yeah, for us, that's really what we're focused on. We think it's very much a stock picker's market at the moment. We're cautiously optimistic, but yeah, that's certainly the focus for us, is being in the right stocks as opposed to overall market exposure.
Okay, so I like that. We love stock pickers. We love being in a stock picker's market because there's plenty of opportunity there. But just to push the point a little bit, I hope you don't mind me saying, but you've just returned from, some work in the United States. Presumably you were out speaking with people, speaking with companies. What sort of reflections can you bring back to us that you can then apply to your filter for small caps, even here domestically?
Yeah, absolutely. I mean, I've just, as you mentioned, spent 3 weeks over there, sort of traveling all over the US, meeting with companies. And I'd say in general, the sentiment over there is quite divergent across businesses versus consumers. Business sentiment, and you can look at some of the, the global surveys, is still at record highs, whereas you've got consumer sentiment, I guess, at record lows, GFC lows. So, what we typically see in that sort of environment is that a market bottom is not too far away, because how does sentiment get much worse? And then how does spend get much worse? But I do think that, we're in this sort of window at the moment whereby you are going to see, this US reporting season, some tough numbers put up by some companies, and you will see some earnings downgrades. But the sectors that still stood out to me as performing quite well is really that tourism and travel space. There are, I guess, some, risks around capacity and whatnot, but in general, yeah, there's no question we're seeing an acceleration in that shift of spend from goods to services as, consumers emerge from the COVID environment. The oil services space was very interesting. I think, over the past 5 years, we've seen significant underinvestment in capex within the oil and gas space, and that's really starting to be reflected now. And obviously the Russia-Ukraine situation's thrown another leg to that sort of trade now too. Outside of that, on the retail side of things, I'd say the discretionary retail side in general felt tougher. But those retailers that are more leveraged to, a reopening, if you like, formal wear, dresses, getting out on occasions, jewelry, those seem to be faring better. So, it was a very interesting trip. I mean, the the technology space, there's a lot of pain being felt in Silicon Valley at the moment in the unprofitable technology space. I think what we're going to see, we're going through an era of essentially free capital to capital actually costing something. So as a result of that, I think you will see consolidation, amongst those smaller players. But in general, the technology space at the upper end, the subscription, SaaS enterprise players seem to be holding up. It's definitely some divergence under the surface there.
Okay, so can we then take those learnings and maybe apply them to specific stocks here? I mean, if you're thinking about, say, travel and tourism locally, if you're in the small cap space, you're not investing in Qantas. So are you thinking about an Experience Co, Apollo, Kelsian? I mean, where are the opportunities here?
Yeah, you've highlighted a couple that we like. So Experience Co we think is really well positioned. Obviously those guys have done a really good job in terms of hiving off some non-core assets and really reconcentrating, refocusing the business. You've got really strong exposure to that domestic recovery in domestic tourism and also international as well. So we think Experience Co is very well positioned. Kelsian we like too. I mean, it's got the combination of obviously the defensive growth assets in the Australian and international bus businesses. And then, they've got very strong tourism leverage, I suppose, through their marine and tourism assets here. So, that one's been sold off a bit recently, I guess, around concerns of the extent of an equity raising that may have to occur for a transaction, potential bus transaction in the UK. But we think on, sub 15 times multiple for those kind of attributes and the tailwinds that are performing, we think that one's a good one to play here.
Consumer discretionary, what comes to mind if people are dressing up and going out? Lovisa, sort of, it's been caught up in a lot of the selling, whereas a lot of people sort of say it's got this store rollout happening, it's got an international potential. Do you think that it could make a go of it overseas?
Yeah, absolutely. I mean, we met with some of the key competitors in the US market, Claire's being the major one over there. And, for context, that business has 1,500 stores in the US alone. Lovisa's global network's at about 600 at the moment. And they're only about 100 stores through their US rollout. So, Lovisa, we think, fast fashion jewelry, average transaction value in the low 20s, and the leverage to that reopening theme. We think that business is strongly positioned to withstand, I guess, a tougher economic environment. And as you said, I mean, the store rollout opportunity there's massive. We've seen recently, I mean, they've opened stores in Canada last week. They've opened some stores in Poland. There's other pockets of Eastern Europe. So we think that expansion from here accelerates.
Okay, what would you not touch with a 10-foot pole, even if it looks cheap right now in the small cap space?
Yeah, I mean, what we kind of bucket at the moment as too hard. And there's some stocks